Welcome back to Let's REI. I'm your host, Jamie Stone, and today we're diving into one of the most powerful and misunderstood tools for funding real estate deals, credit stacking. My guest is David Warren Mitchell, who's helped hundreds of investors unlock 0% credit and turn it into real cash for deals. In this episode, you'll learn how to get approved, avoid costly mistakes, and safely scale your access to capital. Let's jump in. Hey, David, thanks for joining me today on the Let's REI podcast.
Yes, sir. Appreciate you having me, Jamie.
Yeah, I appreciate you being here. So I came across you, I think, about a year ago on it was like a sub-2 Zoom for the Pacific Northwest. You were on there talking about using 0%, 0% debt to go and do business activities with. Since then, I work with you, and I was able to get, I think, upwards of around $70,000, a blend of like personal and business credit that I actually used to fund a private money loan in Georgia. So I wanted to have you on the podcast just to talk a little bit more about this strategy to get other people's money, essentially, and find a little bit more about you, your business, and how you can help people.
Okay. Yeah. And I found it really encouraging that you were one to actually take the funds and then deploy them right away. And you've been getting pretty good returns on it since you've deployed it. And then I know you're getting paid back soon on that deal. And I'm sure you're probably gonna be looking for your next one to line up.
For sure. Yeah. I've got a pretty solid person I work with, and she finds really good borrowers. And I just tell her when I have some money, and she finds me the deal. So it works pretty well.
Heck yeah. That's awesome.
Yep. So I guess my first question is, what drew you into the world of credit stacking, I guess, and how did you realize that you could apply this to real estate investing?
Yeah, so it actually started, it was one of my first mentors when I was just getting into like the whole real estate and business space in general. And he kind of opened my eyes to just like the importance of having really good personal credit and then being able to leverage that get into business credit. And the whole thing that he was teaching me was using other people's money, or OPM. It's kind of like one of those first introductory topics into this. And ever since then, being in that class, I was just one that I saw the huge advantage that can bring to us as entrepreneurs. And even if you're not an entrepreneur, knowing that, your personal credit and credit overall is just a major key and hack. And if you're a US citizen, because, if you don't have that, you're literally paying thousands of dollars more than you should on literally everything. So mortgages, cars, even just your credit that you're using in your day-to-day life. So, for the past coming on to 6 years now, in a month or two, just been studying this game relentlessly and maximizing it to, both fuel my own investments and like myself and assets. And just trying to share the knowledge around because I know how much it's helped me.
Great. That's awesome. So for people that don't know, I guess, can you explain what credit stacking is and how it actually works?
Yeah. So credit stacking is, in the name, it's basically both you're stacking your personal credit, not just your credit score, but actual like access to money that you have. And that is going to apply on the business side as well. So I actually have a visual example that will make the term like really make sense. So like this is a stack right here. This is like one stack of personal and business cards. So using those to be able to leverage to get into more down the line and set yourself up for more 0% money opportunities. And not even just on the credit card side, but when you're building this stuff up, it opens up more doors for your business later on as you continue to grow it.
So it's actually a physical stack of cards as well.
Yeah. So it's both like a physical stack, and then it can also be, when you're getting like a line of credit, you can, stack like a credit card with a line of credit, or with a SBA, or with some equipment financing. Like I had one gentleman I helped out recently. He has a towing company, and so he wanted to get some one or two more new tow trucks. I think it was actually one, but they're pretty expensive, right? So it was like $120,000, and he went to his the the auto lender, and they gave him like a rate of like 8%, and there was some like prepayment penalty. And so he called me up and he's like, "Hey, would you be able to help me out with this?" And just like with literally one phone call, was able to connect him with one of the banking relationships I have,
Mm.
and he was able to get that same exact approval that the dealer gave to him, but with a, I think it was like a 7.2% rate, and with no prepayment penalty. So with one phone call, was able to save him roughly $5,000 over the term of his
No.
loan.
Yeah.
And then he was going to originally put down, I think 10 or 20% on that 120. And so what we actually did for him was, with that same lender, we got him a 0% business credit card. So he was actually able to use that 0% business credit card to fund the down payment as well as get the loan from them. So he was into the new tow truck, $0 out of pocket.
Oh,
And,
okay.
and then obviously you'll use that tow truck to do his runs and
Yeah.
pay that thing back.
So use the credit card to fund the down payment for the other loan. That's interesting. Yeah.
Yeah. Yep. So
Yeah.
that would be like a stack where like, yeah, one is a card, but then one is a loan, equipment financing. Yeah.
Okay. So it sounds like relationships are super important in this strategy with actual lenders, like financial institutions.
Yeah. And like specifically with kind of what we were talking about is like, I mean, the banks, how they make money is of course like lending out money, so they want to, and that's kind of like the shift in mindset that I always try to like throw onto people that are willing to accept it. It's like they're just people, and it's just like if it was your buddy, if you go to him but you've never got, you never borrowed any money from him,
Yeah.
he's going to be less likely to be like, "Oh yeah, I trust you with this large amount of money," versus if you go to him, you say, "Hey, can I borrow $1,000?" And he gives you that $1,000, you pay it back on time, everything as agreed. Now when you go back to him later and you're like, "Hey, I got this thing, would you give me $5,000?" He's much more willing and likely to be able to give you that money now because you've built that prior relationship and shown him that you can be trustworthy.
So you're building up your track record essentially.
Yeah, essentially, it's
Yeah.
like real estate deals, right? Yeah, it's like you don't just like you don't just get all these deals without having
Right.
something in the past to show that you can handle it.
Great. So you mentioned personal credit and we think about business credit. So why is personal credit even looked at?
Yeah, so on the business side, you get to a point in your business where um, you will be able to build up like what we call like corporate credit, where then it's totally detached from your personal side. But especially just starting out, if you're not doing, $1 million in revenue, a year, then you are still on the hook personally. So to be able to like make sure that your personal credit is all in order before going after the business, because although you're a separate entity with your social security number and then
Right.
your EIN on the business side, yeah, if your EIN is controlled by your social security number, but your social security number personal credit score isn't looking right, then it's hard to justify giving you
Right.
any money over here.
That makes sense because you're the one
Yeah.
that's going to be running the business. So when someone starts out, what's the typical process to get approved for 0%? What kind of steps are involved?
Yeah, so depending on, are you asking for like depending on like your personal credit card stacking or business credit card stacking?
Just like in general, so like in my situation, someone like me, where I had to um, look at my personal and my business, like what steps would someone have to, this is your first time going after a credit stack and your intention is to
Mhm.
use that money for something in your business. Probably you want to do a loan or you want to buy something, equipment. What would that look like for someone as their first go around?
Yeah. So typically the first thing that we will look at is making sure that your personal credit is optimized before going for funding. And what that typically would entail is we want to make sure that people are always looking at like the credit score. And I always tell people, like, I don't care what your credit score is. I care about the content in which makes up your credit score. So it's going to be the five factors, won't go over them, but you're looking into the actual details. So like how many cards do you have? What are their limits?
Right.
Limits is a big key because again, what the banks go off of is what they call comparable credit. So on your personal side, if you have very high limits, then it's much more likely that you're going to be able to get much higher limits on the business side. But if you only have one card, I was actually just dealing with a client like this. He only had, but his credit score was like a 805, and
Right.
his one card was only like I think like $5,000. And then we could have another client. So comparing this person with one card but an 800 credit score versus somebody that has maybe like a 710, but they have 10 different cards and 100K on the personal side in terms of limits. Well, the 720 is going to get approved much likely for much higher
Mm.
for new stuff on personal and business than the guy that has a 805. So that's where I'm like,
Yeah.
the credit score is pretty irrelevant to me. It's the details in that. So we've optimized your personal credit by potentially getting you higher limits on the personal side, making sure your score is there and the contents in which make it up. And then we want to make sure that you have that LLC in place and certain characteristics of the LLC are going to be perceived well from the bank's side. So I always look at it of like, okay, if I'm going to go ask this institution for money, how are they going to be perceiving both me and my entity? So in
Right.
terms of the entity, how are they perceiving it? It's like, well, what do most good businesses that are going to pay their money back look like?
Right.
So it's just optimizing it for that. So they probably have a business checking account with us, probably have a website. They probably are in an industry that's not super risky. So, like all of those sort of things, we want to just make sure that are, kind of set in place before actually
Mm.
going for the money. And it seems like a lot though, Jamie, but like obviously like you went through the experience,
Right.
you could probably speak to it. It's like, yeah, it seems like a lot, but it's really not once you just like nail the fundamentals.
Because you're doing a lot of that stuff anyway. But I would say, I know it's come up before where, like, I think the website doesn't have to be that you create, doesn't have to be like super crazy. It's just like a landing page sort of thing, right? But the name is
Yeah.
kind of important of the LLC because I don't think you would have as much success from what I've heard in the past if you had like anything to do with lending in your name or something like that because they don't want to lend you money so you can turn around and lend it, right?
Yeah. Yep. Yep. And yeah, and like other things like typically any industry that would be in their eyes considered higher risk. So that's probably like anything with like investments or construction or fix and flippers, right? And that's not to say those businesses won't be able to get these large 0% business lines and credit stack, but they would have to just like adjust a couple of things before going to the bank because the bank is going to look at that and be like, that's a risky business. So we're not going to give as much, or your approval odds will be lower when you actually do go apply.
Is there, so you said credit score is actually less important than people would think because, we get hammered on credit scores, right? You need a good credit
Mhm.
score for this, that, and the other. But it sounds like that's just probably one piece of the puzzle. Your limits are very important. The number of cards you have and that you're paying them on time is important. With that being said, is there any kind of must have sort of credit cards or I guess bank accounts that someone should kind of, if they're thinking about doing this route, like in preparation before they actually do their first credit stack? Are there any recommendations of companies or banks to work with?
Yeah, for sure. So, like, one thing to just like kind of clarify the distinction between like credit score and like the content which makes up your credit. How I look at it is like in terms of like an engineer, like your input is the credit content. So that's where your utilization is. That's your relationships. That's your limits. The credit score is the output. So that's just like
Mm.
what you get at the end result of all of this stuff over here. Yep. And so then with like actually which banks do people want to start establishing relationships with? I would say for beginners, it's just like you want to think about like, okay, what are the big banks? Because the big banks are most likely to give you the most amount of money. So I want to like start to get those relationships first. So that's going to be all the ones that people have probably heard of: US Bank,
Mm.
Chase, Bank of America, Wells Fargo, all those bigger players. And then as Jamie, you're going through with yours, you're starting to build out that entire relationship network with those guys. And then it's just like, okay, where in the timeline now do I look at, okay, what banks are actually located around me in my physical area where, they could be credit unions or they could be a little bit smaller banks like regional banks or maybe even just like your local ones, and like where in that timeline after you've established like the bigger ones, where do you start to implement the relationship with these smaller ones? That's how I think about like forming the relationships with the banks.
Okay. So once you get access to this credit, right, you got
Hmm.
to figure out, and now it's on a card. How do you
Right.
get it from the card into your bank account so you can actually use it?
Yeah. So like with what you're saying, it's like for specifically like real estate people, they're like, I can't just go and buy this house on a credit card.
Right.
Yeah, so
Or
so for
EMD or yeah, I don't think they you show up to the title company with a credit card to pay your EMD, right?
yeah,
Yeah.
yeah, exactly. So like with what we did with your situation, what we call it, there's kind of like two terms in our industry that people will use, but they're interchangeable. So it's called credit to cash conversion or credit card liquidation, where basically you will take your card and then you're going to run it through a payment processor to either yourself or to a company, and then that company or yourself will then be able to wire that money back into the checking account that you're actually going to want to be able to pull the cash from. So what I recommend for people for that is if you're experienced, and this is like, be very cautious doing it yourself, because if you don't know what you're doing, you can get your card account or your bank account flagged. And
Right.
so yeah, be very cautious about that. So if you're kind of newer to the space, I'd recommend using a company where you pay them as a transaction and then they'll wire it back to you later on, and then you'll be able to use that as cash.
And is that a service that you offer as well?
Yep. So we'd be able to do that service to make sure that like any of the card limits that you want to turn into cash, we would
Mm.
do that, and then we also would, if you don't want to use us, we have other companies that you would be able to use to be able to do go through that whole process.
Yeah, I remember when I was going through the process, there was one card in particular. They were like, you don't want to take the entire amount you want in one shot. You want to break it up into two different transactions, otherwise it'll get flagged. And then the other piece of advice I got was to call the bank first and say, I'm going to be swiping my card for this transaction, just giving you a heads up. And most of the time, like, we don't care. But
Yeah.
by calling them, you're showing that, you just wanted to give them the heads up. So it's less likely that they're going to block the transaction.
Yeah, and there's a lot of those like little rules that that's why I'm saying if people aren't experienced or don't kind of know those things, to recommend doing it through a company that you trust,
Yeah.
because yeah, if you do it yourself, there's a lot of little things in the bank's back end that will get flagged and will
Right.
cause you a lot more headache than it's worth.
Yeah, for sure. I know I tried with one company and it got flagged for some reason. I'm still not sure why. And I appealed it and they wouldn't go forward with it.
Yeah.
So what would you say the biggest risk is with using this strategy?
Yeah, so I have an interesting perspective on the risk side of thing. As a business owner, I think that at least me, I'm speaking about myself, like I'm always in terms of like risk mitigation. So with this, the real risk is like if you can't use literally 0% money to make money, then you probably shouldn't be in business, right?
Yeah.
Or rethink some of your business model, your strategy, because it's 0%. So if you can't get a return on that, and you should ideally be able to get better than better than what it would be just sitting in your account,
Right.
or in a high yield 3 to 4% account. So yeah, the risk would come in if you kind of get to the end of that period and you haven't been able to accumulate enough cash to then pay it back,
Right.
because after that 0% intro period, then it's going to be a high rate. And typically with credit cards in specific, it's going to be 17 to 29%, depending on what they offered you. But of course, again, thinking in terms of risk mitigation, this is why business credit is so important, is because there's a lot of creative strategies where the business side of things, or those institutions that you get those offers through, they're more like internally tracked. So then you might be able to just go to the next bank.
Yeah.
Yeah, you might be able to just go to the next bank and be able to get new 0% money. So yeah, the main risk is like you get to the end of that timeline and it's not you can't pay it back because I don't know what you were doing, not being able to make money with 0%.
Yeah, for sure. So yeah, let's go to, I guess, in terms of using the money, you don't want to be stupid and just buy stuff, right? Because that is
Yeah.
like the dumbest way to the easiest way to get into trouble because you're
Yeah.
going to have to pay this back at some point. And the whole goal of this is that you're using someone else's money to basically leverage it, make some money, and then pay it back, and you keep the money that you made. What do you think the most effective use is, maybe for business, probably like in the real estate space?
Yeah. So the one thing that I want to actually like point out with, kind of with that question was the term leverage.
Right.
So for me, leverage is only using money that like you don't actually have And for people out there, because there's that category of people that think like, all debt's bad, doesn't matter if it's 0% or not. And my like kind of rebuttal to that would be like, because they're not willing to take on leverage. So it's using money that you wouldn't actually like have the cash for right now.
Yeah.
And for those people that are, probably pretty cash heavy, I would say like you are probably more inclined to actually get these 0% cards because again, as a business owner, it's all about risk mitigate. Like I'm a
Yeah.
guy that I like to not have a ton of leverage. Like I have cash where I could pay off all my credit cards and still have a ton of cash left over. I'm still going to get more 0% money because what that does as a business owner is it's going to be able to reduce or it's going to improve my cash flow. So my monthly payments are lower.
Right.
And at the end of the day, I'd rather risk an institution's money than my own cash
Right.
at the end of the day, right? Yeah, and in terms of that, like I think people kind of get that like messed up in their head, like, oh, is this leverage or not? And I think yeah, leverage is more of like spending what you don't have right now. But even if you do have it, like that's you want to go to the banks when you don't need money is
Right.
basically like what I'm saying. When you
Yeah.
don't need it is when they're most likely to give it to you, and it's a lifeline. It's kind of like the analogy of like capital is it's both a shield and a sword.
Mm.
Sword in terms of going out, being able to attack opportunities, and a shield in terms of when unexpected things come up or something happens that you couldn't foresee, then you'll be able to protect yourself and keep your business in business, keep making money because people go out of business because their cash flow dries up. And the goal of business is to stay in the game
Yeah.
until you're able to continue to grow it. So for like real estate investors, yeah, some of the best use cases I've seen people use it for is obviously it's all context dependent of like who you are and where you are with it. But the obvious one, I'm a person, obviously you can see I'm in Alex Hormozzi's mastermind. So I got the $100
Yep.
million playbooks, got the
Yep.
books up top, big fan. And what he always says is S&Me 500 versus the S&P 500, where it's like, yeah, as a real estate investor, again, depends on where you're at. But if you don't have the skill sets to find somebody who does and be, willing to fork over some cash to be able to reduce the amount of mistakes that you're going to make in the beginning because they've already made those mistakes. So I'd rather pay somebody money to teach me all the ways that I can die versus dying and then having to get back up again when I could have just paid someone to avoid all that headache. So yeah, invest in yourself as a real estate investor, and then yeah, invest into advertising because if you don't have throughput in your system to get leads, it's going to be hard to get deals and make money if you don't have leads. Advertising, and then depending on your actual vehicle of how you're going about your business model, then it would be like actually being able to execute. It'd be like yeah, if you're an EMD lender, well, now you have the capital to be able to like fund that EMD. If you're, a kind of a lender like yourself, it's being able to deploy that capital, get a return. If you're a value add or fix and flip person, it's being able to buy the materials, put it in the house, be able to sell it. Yeah, I'm trying to think of is there more business models? Like I know there
Yeah,
is.
I
There's so
think
many
that's
ways.
yeah, like entry fees, I guess, and things like that.
Yeah.
Like the overall is that at the end of it, you're getting a return back where you can pay things off. See, because
Yeah,
you don't ever want to be stuck with that debt.
yeah, and it's all about the timeline and the business model will make that back. Like one thing that I've learned with Hormozzi's newest book, The Money Models, it's like,
Yeah.
what's your payback period? A
Right.
lot of businesses, if you don't get at least a 1-to-1 payback, well, you lost money and you're probably not going to be in business that long. So minimum 1-to-1. But then
Right.
you want to make sure that like he has other like calculations, like your lifetime value of a customer. You want to have it to be at least 3-to-1. And if you want to be able to grow really fast, then you want to make your payback period, collect as much cash upfront within the first 30 days. Because if you can collect your cash back and some within 30 days, the 0% stuff, it's pretty much off the table. It doesn't matter because you can get 30-day money, 0% interest, no matter the card you have, even if it's not 0%.
Oh, okay. Yeah.
Even though
Yeah.
I would still get 0% because
Yeah.
it's there for me, and yeah, it's risk mitigation.
Oh, because you mean like because there's a grace period anyway before you'd have to pay anything back for 30 days.
Yeah. So it's
Yeah.
like, okay, how long is it until like I'm at break even for this, or I've added enough value to make sure that yeah, if I sell this regardless, I'll be able to get the same money back. That sort of deal.
Yeah. Okay. Yeah, that's a good way to look at it. But I guess the safest bet is to just go for the 0% and give yourself,
Yeah, yeah,
because
why
something
not?
could happen in 30 days, right? Yeah.
Yeah,
Um,
exactly, you don't know.
so what's the most common mistakes people make? Maybe they jumped on your Zoom at one point. They're like, I could do this myself. Don't need
Mhm.
David. And
Yeah.
what then what kind of mistakes are they likely to make?
Yeah, I think likely mistakes is yeah, one like unless you're really studying this and because like my company, we literally help people with hundreds of applications a month, so we're getting tons of data back. So if you don't have that data and you're a YouTube University type of person,
Hmm.
the problem with like YouTube in and of itself is such a great like you can do so much, learn so much from YouTube. But if you just go on YouTube and you're also using Chat GPT, whatever you're getting from that, it's only as good as the input from the creator or the large language model of what it has to pull from.
Right.
And so you might get a output or some sort of response from the creator that's making the video or chat gpt or any of the ai models or google that it's pulling from like multiple different sources. So even if you're watching a ton of youtube videos, everyone has a different intention. And even like with youtube and chat gpt, like we know those things can be wrong.
Mm,
And yeah, you don't know if the data is verified because you haven't actually done it yourself. You don't have the data points, you haven't gone through hundreds of applications. So yeah, the thinking and doing it yourself, there's so many things with like banks because you have to think like these are institutions that they have like some of the most data on their consumers or their citizens like across any other industry. And also with that, they are one of the most regulated industries. So there's a ton of things that like yeah, if you don't know certain like kind of roadblocks or things that will raise red flags, and there's a ton of them, then you might end up just shooting yourself in the foot and leaving your personal or your business credit worse off than before, just
right.
because you couldn't have known it. Like you didn't
Mm,
expect it and you
yeah.
didn't have that data to go off of. So you're kind of just guessing.
What would be some, I guess, mitigation for someone that did attempt to do it themselves? They got in over their head and now they're in trouble.
Yeah, I would say, like talk to people that are actually in the space. Like, and I'm saying like, yeah, of course you can talk to me, but you don't have to go through me. There's a million other people that do stuff similar, but like, yeah, talk to somebody that is actually professional in this space and have them take a look at your profile and give them as much context as they need. Like people, especially on some of the calls, they want to like because it's like personal information, there's stories that make up this personal information, sometimes not so easy to tell. But yeah, like give them the relevant like actual data points of like what made that happen, because if you don't give them like the full picture or at least what they need of the full picture, then yeah, it's going to be hard for them to get a get give you some advice on how to be able to like improve it, so on and so forth.
Okay. So let's just say someone successfully got their first 50,000, first $100,000. What path would they go or would they take going forward to like scale that to the next level?
Yeah, so it would depend on like which banks they got that initial funding through. But yeah, it would be to expand it. It's just like expand your network of relationships. Also know which banks that know which cards and know which banks and products that you got from them,
Hmm.
because that same bank that you got the first money through, they might actually have an additional product. So it's like kind of like mapping out which banks have which products, which banks do I already have relationships and products with, and then what are the next ones that I can go through. And then again, obviously, it becomes more important even after that first round to optimize your personal and your business and make sure that all of those what we call like KPIs or data points um, are set in place before going for that next round.
So that sounds like the nuances you're talking about where someone trying to do it themselves would not know those things.
Yeah, exactly. Yeah, especially like I think it's a bit easier to get your first round of funding and kind of stumble your way through it. I think it's definitely feasible. But then yeah, once you're trying to build on top of a foundation of shaky knowledge and you don't know how to optimize now your business credit and the rules behind that, yeah, then you'll probably
Yeah,
maybe make some mistakes.
gotcha.
Yeah.
One last question here. Where do you see credit stacking fitting into like the future of like real estate investing, and like what's your bigger vision for your own business and teaching this strategy?
Yeah, in terms of like long term for the 0% credit and in real estate specifically, I don't really see it ever knock on wood, I don't see the strategy going anywhere anytime soon, just because the reason that the banks actually give out these 0% credit cards, they're giving them out as an intro offer. So
Mm,
it's to get people in the door to their network of products and solutions. And so it's a lot like a lead magnet. So it's hard to, turn that off, because once you get into their ecosystem of products with their 0% offer, and they're going to want you to open up a business checking account. So when you deposit, then they're lending more money than you deposited into their account, 10 to 1. There's some theories on it, like you go deep down the rabbit hole, but yeah,
yeah,
you're going to have a business checking, personal checking. Then they may offer you mortgages, like personal or investment ones. They're going to offer you, yeah, different types of accounts. So I don't see it going anywhere. So I think people should definitely be able to use it. And then me specifically for my business, we've really nailed like the 0% offer game in terms of like helping people out with that and strategizing that. So it's just continuing to build out our data points on both the personal and business side to get better information to help people make decisions off of, because it's really a data game that I'm playing. And this is a big like mindset shift. It's like, thought I was in the business of helping people get funding, which I am,
yeah,
but the bigger business, or the real business that I'm playing and optimizing for, is the data of like, what are the data points? What are people coming in with? What are their results leaving? And then when they come back in, what are those data points now? What are they when they're leaving? So then you accumulate this data to be able to, like, when your future clients come in, you're able to help them make better decisions. So it's all about for me, getting more data, and then also now we're starting to actually help people build on top of the 0% money that they get. So in this game, I've become I've invested a ton into myself and Hormozy's mastermind. I'm in a couple other masterminds. So now it's being able to build on top of that. And if people don't necessarily have the full picture strategy of like, okay, how am I actually going to use this money?
yeah,
It's teaching them maybe certain skill sets or giving them frameworks to actually use the money for and to be able
mm,
to generate returns on. So that's kind of like the next iteration. It's like actually showing
right,
people now, like, here's how I use it. Here's how you could use it.
yeah.
But I always say it's like the Bruce Lee quote, like, apply what is useful, discard what is not, and make
Yeah.
it uniquely your own. That's what I would say.
Yeah, it's a good way to look at it. You're broadening your view as to the different uses for it. It's not just real estate, it's just other things in business as well, or yeah, investing in yourself and everything else.
Yeah, and we say like real estate as like this big like catch-all category, but like as being in sub 2, like there's a million ways to make money in real estate. And in some of those different kind of like business models, there's a million things that like make up those business models. Like for every
Yeah.
business model, you're going to need leads. You're going to need to know how to talk to people and to sell. You're going to need to know how to execute on the deals. You're going to need to know how to like, improve your relationship with the people that you're actually doing business with so that they continue to do business with you. So it's like all of
Yeah.
those things under one big umbrella is kind of funny to me.
Yeah, yeah, for sure. Well, thank you, David, for breaking all this down for me today. And I think people watching this will get some great value from it. And they're probably going to want to reach out to you, I'm sure. So, what's the best way that people can find you online or wherever?
Yeah, so to reach out to me, I would just go to my company's website, 10xreup.com. Or if you want a cell phone to text or call, you can call the numbers 269-5954. And me or one of our other agents will be able to help to set you up to a call and see kind of what your situation is to see if we can potentially help.
Oh, that's great. Yeah, you'll probably get some calls, I'm sure, because this is a lot of people talk about this strategy, but it's kind of elusive, I think, until you dig
Yeah.
into it. And some people, you know, tell you not to do it, and other people say, no, it's awesome. You just gotta find the right person. So again, appreciate you coming on, and I will put that information in the show notes as well so people can find it easily. So again,
Appreciate you having me,
thanks
Jamie.
again.
It was super fun. Yeah.
All right, take care. That's a wrap for today's episode of Let's REI. Huge thanks to David Warren Mitchell for breaking down how to leverage 0% credit to fund your next deal. If you want to learn more or see how credit stacking could work for you, head over to his website at 10xreup.com or call him directly at 612-269-5954. As always, hit subscribe, share this with a friend, and I'll see you on the next episode.